Something just broke in the global financial system, and it happened while you were sleeping. Ladies and gentlemen, Asian guy here. It's 6:47 a.m. Eastern Time, and I need you to understand what transpired in the darkness between yesterday's market close and this morning's open. Because what I'm about to show you isn't just a number on a screen. It's the sound of the most powerful financial institution on Earth admitting defeat. At exactly 3:17 a.m., the Federal Reserve Bank of New York executed an emergency reverse repurchase operation. The amount? $34,251,000,000. In the dead of night, on a day when the markets were supposed to be calm. But the mechanics of this operation tell a darker story. Federal Reserve data shows the repo was executed through the primary dealer network, but with an unusual twist. Instead of the typical competitive bidding process, this was a direct allocation. No auction, no market discovery, just a predetermined amount distributed to predetermined recipients at a predetermined rate. That's not how emergency liquidity is supposed to work. That's how controlled demolitions work. Someone knew exactly how much money would be needed, exactly which banks would need it, and exactly when they would need it. This wasn't crisis management. This was crisis orchestration. The interest rate charged was 50 basis points below the federal funds rate, below market, below cost. The Federal Reserve wasn't just lending money to save these banks, they were subsidizing their survival. They were paying banks to accept bailout money. Now, let me explain what this means. The repo facility isn't where healthy banks go to get a business loan. This is the emergency room. This is where banks go when they're bleeding to death. When you see a $34 billion injection at 3 in the morning, you're not looking at routine liquidity management. You're looking at a panic response. But here's where this gets interesting. Here's where the story stops being about banking and starts being about war. The timing is impossible to ignore. Yesterday, silver closed at $76.18. Overnight, it gapped to $79.43 in Asian trading. That's a $3 move on no news, no industrial report, no mining disruption, just pure violent price discovery. And somewhere in those $3, someone's risk management system screamed. Think about the mathematics of leverage. One silver futures contract controls 5,000 ounces. If you're short 10,000 contracts and silver moves $3 against you, you just lost $150 million before your morning coffee. But we're not talking about 10,000 contracts. We're talking about positions that number in the hundreds of thousands. Positions that were built over years. Positions that were designed to suppress the price of silver indefinitely until China changed the game. Because while the Federal Reserve was printing $34 billion to save American banks from their silver shorts, Beijing was making a very different calculation. They weren't printing money to fight the market. They were using money to corner it. The export licensing system that goes into effect isn't just bureaucratic paperwork. It's a financial weapon. Every ounce of silver that leaves China now requires government approval. Every transaction gets reviewed by state officials who understand exactly what silver means to the Western financial system. And those officials have decided that the West doesn't get to have it anymore. But the licensing system was just the public face of a much deeper operation. Chinese state banks have been quietly accumulating massive silver positions for 18 months. Conservative estimates put Chinese government-linked holdings at over 800 million ounces. That's not just a strategic reserve, that's a corner. They accumulated it while Western banks were shorting the market to keep prices low. The Western banks were unknowingly subsidizing their own destruction. Let me walk you through what happened last night, step by step. At approximately midnight Shanghai time, major Chinese refiners began receiving calls, not orders, calls. Strategic communications from entities that don't usually engage in commodity markets. These weren't industrial buyers looking for silver to make solar panels. These were state-directed purchases designed to absorb every available ounce before Western arbitrage traders could react. But the coordination went deeper. Intelligence sources report similar calls to dealers in Singapore, Hong Kong, and Dubai. The message was consistent. Execute immediately, pay any premium, secure delivery within 48 hours. This wasn't a market operation. This was a military operation disguised as commodity trading. The price in Shanghai spiked to $81.97, while New York still showed 76.18. That spread represents more than just a pricing discrepancy. It represents the moment when Eastern determination overwhelmed Western manipulation. For months, trading desks in New York had been dumping silver futures at strategic times to keep prices contained. Every rally was met with algorithmic selling. Every breakout was smothered with paper contracts. But algorithms assume infinite supply. They assume that for every buyer, a seller can be manufactured. They assume that markets are infinitely liquid and infinitely manipulable. Chinese state buying broke those assumptions. When Beijing decided to absorb physical silver at any price, Western algorithms became obsolete overnight. You cannot algorithmically trade against an entity that doesn't care about profit, doesn't respond to technical analysis, and has unlimited capital backing. The Shanghai Premium wasn't just a price signal. It was a declaration of war against the concept of paper price discovery. It was Beijing announcing that they would set the real price of silver, and the West could either accept that reality or print money fighting it. That spread, that $5 gap, represents the exact moment when the global silver market fractured into two separate realities, East and West, physical and paper, real and imaginary. But the Federal Reserve couldn't let that gap exist. Because if silver trades at $82 in Shanghai and $76 in New York, every bank, every hedge fund, every algorithmic trading system in the world should be buying in New York and selling in Shanghai. The arbitrage opportunity is mathematically perfect. Risk-free money. Except the arbitrage isn't working, and the Fed knows why. The $34 billion injection wasn't just about margin calls. It was about preventing a delivery crisis that would expose the fact that the Western silver market has been running on vapors for years. The registered inventory at the COMEX, the metal that's actually available for delivery, has been hemorrhaging for months. Every time the price spikes, more contracts stand for delivery, and every delivery drains the system. But tonight was different. Tonight, the Chinese buyers weren't just taking delivery. They were taking everything. The repo injection tells us that American banks couldn't find $34 billion in cash to meet their obligations. They had to pawn their treasury bonds to the Federal Reserve just to stay alive. Think about that. The institutions that create money had to borrow money to avoid bankruptcy. But the Federal Reserve's own data reveals something even more disturbing. The $34 billion injection wasn't spread across multiple institutions. According to the primary dealer reports, 3 banks accounted for over $28 billion of the total. 3 banks. 3 systemically important financial institutions were simultaneously facing liquidity crises at exactly the same moment that silver spiked. The identity of these banks isn't officially disclosed, but market intelligence points to the usual suspects, the institutions that have dominated precious metals trading for decades. The same entities that assured regulators their short positions were hedged, their risk was manageable, their exposure was contained. They lied. Or more accurately, they believed their own lies until reality intervened. The internal stress tests these banks ran were based on historical price movements. Silver moving 5% in a day was considered an extreme scenario. Silver moving 15% was considered impossible. But when Chinese demand hit the market with state-level capital backing, historical models became worthless. The algorithms broke. The risk management systems failed. The humans panicked. The cascading failures were immediate. Trading desks that had operated on autopilot for years suddenly required manual intervention. Risk officers who hadn't worked weekends in decades were called in at midnight. Board members who thought precious metals were a quaint side business discovered their banks were existentially exposed to a metal they barely understood. And when humans panic at 3 in the morning, they call the Federal Reserve. But the Fed's intervention reveals a terrifying precedent. They've now established that silver shorts are too big to fail, that precious metals manipulation is systemically important, that any threat to the suppression scheme will be met with unlimited dollar creation. This guarantee fundamentally changes the game. Chinese strategists now know exactly how much it costs to force American money printing. They know that every $10 move in silver triggers roughly 20 billion in emergency liquidity. They can calculate the precise cost of destroying dollar credibility. And they can afford it. And all because the price of a shiny metal moved $3. But the real message, the message that should terrify every holder of dollar-denominated assets, isn't what the Fed did. It's what China didn't do. While America was printing money to fight the market, China was using money to own it. They didn't need emergency liquidity operations. They didn't need midnight bailouts. They just needed to make a phone call to their refiners and say one word: buy. Every ounce that moved from Western vaults to Eastern storage last night represents a permanent transfer of monetary power. Silver doesn't care about politics. It doesn't care about trade wars. It only cares about scarcity. And Beijing has just engineered artificial scarcity for the West while creating abundant supply for themselves. The mathematical inevitability is staggering. If Chinese demand absorbs Western supply, and Chinese export controls prevent Western access, then Western prices must rise to destroy Western demand. It's not manipulation, it's physics. But the Federal Reserve is trapped. Every time they print money to save the silver shorts, they devalue the dollar. Every time they devalue the dollar, hard assets become more attractive. Every time silver becomes more attractive, the shorts get deeper underwater. They're trying to put out a fire with gasoline. The 34 billion injection proves that the suppression mechanism is broken. For decades, the game worked because Western banks could always find more paper to sell, more contracts to dump on the market, more imaginary silver to keep the price down, but paper silver requires confidence. And confidence requires delivery capability. And delivery capability requires physical metal, and physical metal requires Chinese cooperation, and Chinese cooperation just ended it. The export licensing system isn't scheduled to begin tomorrow. It's not a future threat. According to sources in Shanghai, enforcement began 3 hours ago. Retroactively, every silver shipment that was supposed to leave Chinese ports today has been placed under administrative review. The bridge is burning while people are still on it. This creates a psychological shift that the banking system cannot handle. For years, silver traders operated under the assumption that supply was infinite, that if demand spiked, more metal would appear, that if prices rose, miners would produce more, refiners would work faster, and the market would balance. But supply isn't infinite when it's controlled by a government that wants to see your currency fail. The $34 billion repo injection is the first payment in what will become an endless series of payments. Because the problem isn't going away. Chinese demand isn't decreasing, Western supply isn't increasing, and the mathematical gap between those two realities grows wider every day. Every dollar the Fed prints to save the shorts makes the shorts more expensive to maintain. Every intervention creates the need for a bigger intervention. The debt spiral has begun. And the truly terrifying part? This is just silver. This is just one market, one metal, one relatively small corner of the global financial system. If a $3 move in silver requires a $34 billion bailout, what happens when gold moves? What happens when copper moves? What happens when China decides to restrict rare earth exports or lithium or any of the dozens of strategic materials that the Western economy depends on? The Federal Reserve has just revealed the blueprint for their own destruction. They've proven that American banks are so leveraged, so dependent on artificially suppressed commodity prices, that a tiny movement in one market can bring down the entire system. And Beijing is watching, and learning, and planning. The Chinese leadership isn't just fighting for silver. They're testing the limits of American financial power. Every repo injection, every bailout, every desperate measure to keep the banking system alive is being cataloged, analyzed, and weaponized for future use. They've discovered that a relatively small amount of strategic commodity buying can force the Federal Reserve into emergency actions. They've learned that American banks are far more leveraged and far more fragile than anyone publicly admitted. They've identified the exact pressure points that can bring down the entire Western financial system. But the scope of Chinese preparation goes far beyond silver. Intelligence reports suggest they've been running similar accumulation strategies across dozens of critical materials: lithium for batteries, rare earths for electronics, cobalt for electric vehicles, copper for infrastructure. They're not just cornering one market, they're cornering the entire periodic table. The pattern is consistent across all commodities. Patient accumulation during Western suppression, strategic timing to maximize Western pain, and always the conversion of paper positions into physical ownership. They learned from America's gold default in 1971. They understand that paper promises can be broken, but physical possession cannot be negotiated away, and they're sharing this information with their allies. Russia is watching how silver breaks American banks. Iran is taking notes on how commodity restrictions can force money printing. Every nation that wants to challenge American financial dominance is studying the playbook that China just wrote. The BRICS nations are coordinating their resource strategies. When China restricts silver exports, Russia restricts palladium. When Russia limits energy supplies, Brazil restricts agricultural exports. When Brazil cuts food shipments, India restricts pharmaceutical ingredients. They're creating a web of interdependent shortages designed to overwhelm American crisis response capabilities. The Federal Reserve can handle one emergency injection. They can manage one $34 billion bailout. But can they handle simultaneous crises across energy, food, metals, and technology? Can they print enough money to save every over-leveraged bank, fund every strategic stockpile, and maintain dollar credibility simultaneously? Beijing is betting they cannot, and they're about to find out. The $34 billion injection happened at 3 a.m. because they hoped nobody would notice. They buried it in the overnight data, mixed it with routine operations, disguised it as normal central bank activity. But the size betrays the desperation. $34 billion doesn't just materialize for routine operations. The timing was calculated to minimize market reaction. 3 a.m. Eastern means 9 a.m. in London, 3 p.m. in Singapore, 4 p.m. in Tokyo. Peak trading hours in every major financial center except New York. By the time American markets opened, the injection would be old news, buried in overnight reports that most traders never read. But burying the news doesn't change the mathematics. $34 billion in emergency liquidity means $34 billion of losses were about to materialize. Someone, somewhere, was facing immediate insolvency. Someone whose failure would cascade through counterparty relationships, clearing houses, and derivative networks. The Federal Reserve doesn't intervene to save individual institutions. They intervene to save the system, which means the system itself was at risk. Someone, somewhere, was hours away from bankruptcy. Someone with enough systemic importance that their failure would cascade through the entire financial system. Someone whose survival required the immediate creation of $34 billion out of thin air. And that someone was short silver. The war isn't coming. The war is here. It's not being fought with missiles or soldiers. It's being fought with export licenses and repo operations. China fires by restricting supply. America responds by printing money. China fires again by buying more. America prints more. And every shot makes America weaker and China stronger. The silver market died last night at 3:17 a.m. What replaced it is something entirely different. Something that doesn't follow the old rules. Something that doesn't respect Western financial engineering. What emerged from that $34 billion emergency injection was a new reality. A reality where physical assets trump paper promises. Where Eastern patience defeats Western leverage. Where the country that makes things has more power than the country that prints things. The implications extend far beyond precious metals trading. Every industry that depends on Chinese supply chains is now vulnerable to strategic restriction. Tesla needs Chinese lithium for batteries. Apple needs Chinese rare earths for phones. Boeing needs Chinese titanium for aircraft. The entire American economy is built on the assumption that China will continue selling critical materials at prices that make American manufacturing competitive. That assumption just died. The export licensing system for silver is the prototype for a broader economic weapon. If Beijing can force a $34 billion Fed intervention with silver restrictions, imagine what they can accomplish by restricting semiconductor materials or battery components or pharmaceutical ingredients. American policymakers are waking up to a horrifying reality. The supply chains they outsource to China for cost efficiency have become strategic vulnerabilities. The same globalization that made American corporations profitable has made American sovereignty impossible. And there's no quick fix. You cannot rebuild decades of manufacturing capacity overnight. You cannot create alternative supply chains with emergency legislation. You cannot print your way out of a physical shortage. The Federal Reserve's $34 billion injection bought time, not solutions. It prevented immediate bank failures, but it didn't address the underlying problem. Chinese control over critical materials isn't going away. If anything, it's going to intensify. The next crisis will be bigger. The next emergency injection will be larger. The next bailout will be more desperate, because China isn't stopping with silver. This was just the opening move in a much larger game. The playbook is now written. Apply pressure to over-leveraged Western positions. Force emergency liquidity injections. Document the exact cost of American financial fragility. Repeat with the next strategic commodity. Each iteration teaches Beijing exactly how much pressure the system can handle before it breaks completely. And every dollar printed in response brings that breaking point closer. The Federal Reserve can print dollars, but they cannot print silver. And China has the silver. The game is over. The question now is how long it takes everyone else to realize it.